Well, Category 4 Hurricane Milton is barreling towards Florida and is expected to make landfall on Wednesday. The last devastating storm to hit the U.S. was Helene. Damages from that Category 4 storm might cost over $30 billion, according to analysis by CoreLogic. And its impact on the jobs market and the economy in the southeastern part of the country is still yet to be seen.
To discuss the storm's potential impact, we want to bring in Dana Peterson, the Conference Board's chief economist. Dana, it's great to have you. So we're trying to figure out exactly the impact here, the economic impact, aside from what is most important here in terms of the health and safety of so many of those who will be and ultimately, unfortunately, will be affected by this storm. But zeroing in on the economic impact of this storm, what should investors be thinking about just in terms of the potential disruption or looming effects this could have on the economy and ultimately the labor market?
Absolutely. Certainly, initially, when the storm hits, it's very damaging and costs a lot of destruction and also disruption in terms of employment. But over time, some of those costs can be offset by rebuilding. Now, when we look at the amount of money that hurricanes have caused from 1980 through 2023, damages were upwards of $2.6 trillion. That's roughly $60 billion a year. So imagine that as a share of GDP, that's like 0.2%, but it could potentially cut anywhere from up to 0.3 off of GDP after the event. However, a lot of that can potentially be offset by rebuilding, but nonetheless, it's highly disruptive. And when we look at the storms that have been coming through, they've been impacting large swaths of the labor market.
And when we think about that, what are the sectors within the labor market that tend to see the biggest impact as a result of these storms and the severity that we've seen to this juncture in the hurricane season?
Sure. Anything that heavily relies on infrastructure. So, for example, ports being closed or bridges and roads being washed out, that affects transportation. Also, while there's downside there's also potential upside, certainly for grocers who, people go and they buy food, and also home repair types of companies that provide the materials not only for preparation for the storm, but also for after rebuilding.
Dana, to what degree does an event like this, past hurricanes, does that complicate maybe the interpretation of this economic data and potentially, I guess, cause an overhang here within the data?
Yeah, certainly immediately you do see that economic impact. It also affects insurance costs. And we know that many insurers, home insurers, are either raising premiums or moving out of areas that have been subject to a lot of natural disasters. So you have these second and third round effects that may not be completely offset by the ultimate rebuilding that must happen to replace infrastructure, goods that have been destroyed, homes that have been destroyed, and items that have been lost.
Dana, what's the timeline of the distorted data or the impact of the data that hurricanes of this magnitude could cause?
Sure. I mean, usually you'll see the impact within a month and consequently within the quarter. It also depends on where the hurricane lands and where in a particular state the hurricane affects. So if it's in rural areas that are sparsely populated, or in areas where there aren't a lot of people or businesses, then the damages can be less so, as opposed if it barrels through a major metropolitan area. So you'll tend to see those effects certainly very immediately on the ground, and then it'll show up in the data within the month or even a quarter. But certainly when we look at payrolls, we could see some effects, certainly from last week's Hurricane Helene, which impacted at least 3 states, and also the Hurricane Milton that's headed for Florida.
Dana, kind of sans hurricane, just for a hot second here, or even kind of beyond the effects of that, more broadly, as I was taking a look through the Conference Board Employment Trends Index that actually decreased in September, I wonder how you would describe the labor market as a whole, especially as we're moving towards the November meeting for the Fed. Of course, chronological order, of course, we're moving towards it. But at the end of the day, that's going to be a different type of conversation, it seems, when you have a higher than expected jobs report that just came out for the most recent month that they're also going to have to evaluate, especially as it relates to their own Fed policy pathway.
Sure. We've been looking at the data over the last few months, and our sense is that the U.S. labor market is fine. Yes, payrolls are not 200,000 a month. We don't need that. Certainly when you're at full employment, which is where I think we are, the unemployment rate ticked back down, and even the uptick we saw was really related to kind of temporary factors. And the natural rate of unemployment is probably around 4.5%. So at 4.1%, we're fine. And certainly heading into the November Fed meeting, I think the Fed can probably go 25 basis points again because they have been saying the labor market right now is solid. And really that 50 basis points of cuts was kind of insurance to make sure that we didn't see realization of any downside risks to the labor market. But there was never any indication that, at least from the Fed, that, the labor market was in trouble. So I think that, heading into the meeting, the labor market is fine. Yes, we may see some impacts from the hurricane, but the Fed is certainly going to look through those impacts.
All right, Dana Peterson, thanks so much for hopping on with us here this morning, the Conference Board's chief economist. Thanks, Dana.